Right, let's make a start. Good morning, everybody, and thanks ever so much for attending our first brief account of 2022. For those of you that don't know me, I'm David Gooding, and I head up our National Accountants Liability team. I'm really pleased today to be joined by my partners, Lisa Taylor and Liam Burnett from London and Leeds. Now, look, as is the central aim of a brief account series, we will provide you with a short overview of some of the key themes and issues arising out of accountants' liability over the last year. We'll also provide you with a few thoughts for the future too. Now, the normal format for a brief account is a 15-minute session. So you're in for a treat today. There's a slight change of format given we've got 3 speakers and quite a lot to cover. So we've doubled that to 30 minutes. We will have chance for a Q&A session at the end. So if you've got any questions as we're going along, please do fire them through the chat. And my colleague Harriet Strevens will marshal those questions at the end. I should say as well, we'll also be following up today with some short briefings on our website. So let me hand over to Lisa Taylor, who's now going to consider some key themes arising out of some recent decisions.
Great, thanks very much, David. So let's look at the first case, which is the landmark 2021 Supreme Court case of Manchester Building Society versus Grant Thornton. Now, the facts of this are complicated, and we've published some articles giving further information and our analysis of the case, but for today's purposes, I'll give you some brief facts. Grant Thornton audited the accounts of MBS from 1997 to 2012, and during this time, MBS issued a number of fixed interest lifetime mortgages in the UK and Spain, which were designed to release equity. Whilst MBS charged interest at a fixed rate, it funded the loans by borrowing at variable rates of interest. And this created the risk that MBS could suffer a loss if the variable rate exceeded the fixed rate. And so it hedged its position by purchasing interest rate swaps. MBS, however, suffered a significant loss of almost £50 million and claimed that Grant Thornton, as their accountants and auditors, was responsible for the losses that flowed from them having broken the rate swaps, and that this came from the negligent advice they'd given to apply hedge accounting. Now, scope of duty is one of the first things to consider when looking at a claim against a professional. And in this case, breach of duty was accepted by Grant Thornton, but it's also necessary to look at scope of duty when considering quantum. Quantum has 3 aspects. Causation is the negligent advice, the cause of the loss claimed. Secondly, foreseeability, is the loss reasonably foreseeable? And finally, is the loss within the scope of the duty of care owed, and which many of you will know as the Samco principle. And this case concerned this element. The Supreme Court took the opportunity to restate the law on the scope of an accountant's duty of care and unanimously allowed MBS's appeal, with a majority holding that the correct approach was to identify the purpose to be served by the duty of care assumed by the accountants, and then to ask whether there was a sufficient nexus between the claimant's loss and the purpose. The court found that the damages claimed by MBS for the cost of closing the swaps were within the scope of the accountant's duty. So how will this decision be used in practice? Well, the focus of the parties should now be on identifying the risks the professional was supposed to guard against, objectively speaking. Claimants will inevitably use this judgment as justification for trying to recover a greater scope of losses than they perhaps would have done before, and also widen the scope of duty. Accountants giving advice should therefore take note of the purpose of duty question and check their terms of engagement to ensure that they are absolutely clear on the agreed purpose of the advice being sought and provided. The second case that claims adjusters and accountants should be aware of is Knights versus Townsend Harrison. And this is a relatively recent High Court decision from November 2021, which also looked at scope of duty and considered the principles which have been set out by the Supreme Court in Manchester Building Society. So again, some brief facts from this case. This was a claim brought by various companies which were run by Mr. and Mrs. Knight, which rented out very successfully artificial foliage for events. And they were they were clients of the defendant firm of accountants and had been since 2011. They claimed from the accountants losses which had been suffered and which were potentially going to be suffered after the accountants introduced them to 3 tax schemes and a foreign exchange trading scheme. 2 of those 3 tax schemes failed and the foreign exchange trading scheme failed, with the final tax scheme looking likely to go the same way. The claimants alleged that when the defendants had introduced them to the schemes, it had owed them a duty of care in doing so, and alternatively that statements made by the defendants about the schemes had actually been advice. Now, in relation to the third scheme, which hadn't yet failed, it was alleged that the defendant ought to have provided advice about the schemes, but hadn't done so. The claimants also argued that when the defendants had introduced the schemes to them, it had a duty to carry out appropriate due diligence, which it hadn't done. Now, in defence to the allegations, the defendant argued it didn't provide any advice, but merely introduced the schemes to them. And in making that argument, they relied on their engagement letters. And that included an exclusion which stated that the defendant might, and then quotation marks, advise you on your investments generally, but not recommend a particular investment or type of investment. Now, in addition to the letters of engagement, the firm of accountants had also sent limitation of liability letters in relation to each of those matters. In considering the position, the court found that the appropriate test was whether the defendant had assumed a responsibility to advise the claimants in relation to the tax schemes. And helpfully, the court commented generally on introductions made by accountants to their clients. Now, this is an issue which comes up time and time again, and I'm currently dealing with a case about this exact issue. And so it's really very helpful to have some judicial guidance on this issue. The court found that the defendant had not assumed a responsibility in relation to the tax schemes and therefore did not owe the claimants a duty of care. The court specifically noted that the defendant's engagement letter stated it would not recommend a specific scheme, as did its terms of business. These letters were not mere formalities, and they expressly stated the defendants would not provide advice. This was clear evidence of the accountant's intention, and this was even further supported by the limitation of liability letters that had been sent out in each of the four matters. Interestingly, though, there was one scheme where the limitation of liability letter hadn't been signed by the claimants, but here the court held that there was an established relationship between the parties, and the failure to sign that form had not changed that relationship. The court also found that despite a director of the defendant having made encouraging comments regarding the investment scheme and having visited the company which ran the scheme, this hadn't amounted to an assumption of responsibility to carry out checks. There needed to be more than that. So these authorities are really helpful in that they give some clear messages that those involved in adjusting claims or underwriting accountants' policies or firms themselves should be aware of. The main themes from both of them relate to duty, both the scope and the purpose of the duty. And it's really important that this aspect is looked at carefully, both at the start when establishing breach, but also when looking at assessment of loss. Now, this is consistent with professional indemnity claims generally, but very relevant in relation to claims against accountants. So what messages can firms and their insurers take from these decisions, and what could and should they be doing to protect their position as far as possible in the event a claim should arise? So you'll see on the slide I've set out there some practical tips. So I'll just quickly go through each of those. First of all, it's important to clearly agree and define the scope of the appointment and record the services the firm is providing from the start. Given that an accountant's role can be a broad one, this is really vital that it's done to avoid retainer creep. And it should be done by way of a clear and unambiguous letter of engagement, limitation of liability letter, or terms of business, and should be done ideally before any work is undertaken. It should also be made clear what isn't being provided, and limits of liability should be reviewed and considered. Secondly, make sure the letters are returned and signed and retained on the file. And although the court in Townsend Harrison didn't find this a necessity, this was based on the ongoing relationship and the letters having been signed in the other matters. And it's also a matter of good practice. Thirdly, consider and keep under review the reason the advice is being sought and its purpose. And this relates back to the MBS decision. This might not always be immediately obvious, and so further questions should be asked if it's not, and then record why the client is seeking the advice. And this will help establish what the client is seeking to protect against or avoid. Fourth, firms should refresh the scope of the terms of engagement if they're asked to undertake any further work. And finally, when a firm is making an introduction to a particular scheme or investment rather than providing advice, there needs to be clear communication with the client. And as already mentioned, it's crucial that that understanding is documented. That's all from me, but I'll pass you over to Liam to talk about trends.
Thanks, Lisa. So I'm going to talk about some of the trends that we've seen develop during the pandemic. But before I do that, just for a little bit of scene setting, what did we see before COVID hit our shores? Well, claims against accountants were relatively mild, and the tax avoidance threat had largely dissipated. And generally, you only get a wave of claims against accountants where there's a genuine recession, and we haven't seen that for some time. So pandemic shock in itself was unlikely to generate wholesale claims unless it developed into a full-blown economic downturn that resulted in business failures. Now, we saw some of that in the retail sector, but thankfully it hasn't happened across the board. And the good news is that the economy is probably back to where it was before the pandemic. But we have started to see some trends begin to emerge. Firstly, with furlough, this is an area where we have seen claims, largely as a result of late filing, where there are very strict deadlines for filing and making a claim. There's no right of appeal to HMRC, only if, I suspect, if HMRC exercise their discretion where they think there's a reasonable excuse for not meeting a deadline. However, it's discretionary, and also it's not always easy to spot what might be a reasonable excuse. However, if you are faced with a claim, the important things to check, as Lisa set out in some detail, the scope of the retainer. So did the accountant give clear advice about the timescales and the deadline for making a claim? Was the client at fault perhaps for providing information at the last minute? Or was it a complete data dump that made making the claim and processing the claim more difficult, so a deadline was missed? The good news is that most of the claims that we have seen are relatively low value, but we have seen claims for six-figure sums. Now, regardless of the value, they need to be dealt with, and hopefully we've given you some helpful tips. We've also seen claims arise from miscalculations, and that's either underclaimed furlough or overclaimed furlough. Either way, putting a strain on the cash flow of the business. Fortunately, HMRC did provide some clarification before Christmas that businesses could offset overpayments and underpayments against one another as long as they occurred during the same tax period. Now, given that there's a window here to correct past mistakes, accountants should remain vigilant. Fraud is another area when it comes to furlough where we've seen some claims start to arise. Now, employers received 70 billion in wage support through the coronavirus job retention scheme. And it's widely reported that almost £6 billion of that sum, so nearly 10% of those claims, were fraudulent. Now, reports last week indicate the government might only expect to recover around £1.5 billion of the amounts fraudulently claimed. And guess who's paying the rest of that? Now, we have seen some claims activity where the fraud was committed, let's say, by a rogue director or employee, and it should have been spotted by the accountant who made the claim, especially where the same firm was in charge of the payroll function or perhaps even carried out an audit. Now, if the fraud was so obvious that it should have been spotted and reported, that may also lead to regulatory or disciplinary action being taken against the firm. So it's an area to look out for. Moving on, home and hybrid working has presented and will continue to present challenges, especially when it comes to how confidential and sensitive client data is being protected, where people living in the same home work with different companies and clients. And also think about how that information is being secured. You know, it's on laptops, it's on tablets, and it might be physical documents. And people need to think about, and employers need to think about how that confidential information is being disposed of. There's also an increased risk of facing a cyber attack just because of the day and age we live in, and ransomware attacks in particular. And finally, there is an increased risk around people, especially supervision and how the job is carried out. Now, this is something I'll come back to later on, but can we say with confidence that we now know fully what mistakes were made and the potential impact that they've had? And I don't think we can say that. Moving on to audit claims. Now, they tend to be high value but low frequency, but we've started to see issues arise from the pandemic where, for example, the audit firms haven't been able to carry out site visits or certain investigations. Now, while some of the challenges around audit inspection of client records should change as businesses move closer to having complete electronic records, and there's a big push for that through the Making Tax digital reforms that will be introduced at various stages over the next few years. I was surprised to see an article a couple of weeks ago which reported that more than 2 million SME owners risk falling foul of the new rules. And those are the Making Tax digital reforms for VAT that come in April this year. Now, a study carried out by the Accountancy Partnership revealed that almost 40% of 1,200 entrepreneurs surveyed still use paper-based systems or a collection of photographs to keep track of their finances. Now, that's only a relatively small snapshot, but a surprisingly large proportion of the entrepreneurs interviewed still relying on paper. Now, whilst those businesses might have an audit exemption, they can still choose to be audited. And so that the pandemic for those businesses and their auditors potentially added an additional layer of risk. We also see lots of claims generally before and during the pandemic arise from general accounting errors and tax advice. Now here we're talking about late filing errors that result in penalties or potentially claims we make for tax relief where the claim is incorrectly made and subsequently challenged by HMRC. Now, time for a quick poll. Over the last 2 years, and you'll see this up on your screen coming up now, over the last 2 years, out of the 33,000 tax claims that were queried by HMRC, how many think you were dropped by HMRC? Now let's wait a minute for those answers to come in. Okay, we can see those results now. Wow, okay, so 31% of you think 20% were dropped. Around a quarter of you think 30% were dropped, 10% say 40%, and a third say 50% of those claims were dropped. Well, the answer is 50%, almost half, just over 16,000 of the claims made were dropped altogether. Only 40% of the overall claims that were initially queried were upheld, with 10% of those claims either altered, perhaps because the claim for relief was reduced, or varied if a claim was made for a different type of relief. So not always bad if HMRC raises a query. So what do we see coming down the line? What next? Well, we think much of the same. We expect home and hybrid working conditions to continue to present challenges, especially around how data is secured and how supervision is carried out. Audit is also likely to present a risk area. We've seen lots of large and high profile claims coming through the courts in the last few years. And we've also had the fallout from large scale company failures like Carillion, Thomas Cook and BHS. So after a consultation process last year, there are now proposals in place to reform the audit process. The aim of those reforms is to largely restore the trust in the way that the UK's largest companies are run, and also to restore faith in the UK as a marketplace for major businesses by giving the stakeholders in those businesses, so investors, creditors and employees, more reliable and meaningful information about a company's performance. If those changes are adopted, then they're expected to reduce the dominance of the big four accountancy firms by introducing a managed shared audit. Now, shared audits were commonplace before the big four grew to such a size that they were large enough to audit the largest public limited companies on their own. A new shared audit regime would see KPMG, Deloitte, PwC and Ernst & Young hand over at least 30% of an audit job to a smaller firm that successfully pitches for that work. Now, challenger firms to the big four like BDO and Grant Thornton are resisting these changes because they still want to be able to target FTSE 250 businesses and audit them on their own. The main risk for insurers of accountancy businesses is that in the short term, some of the smaller firms, and I'm not talking about from number 7 to 20, the top 20 firms here, but some of the smaller firms that look to attack this space risk swimming upstream and taking on too much work too soon that they may not initially have the expertise or experience to take on. The financial risk for those smaller firms and their insurers of stepping up to audit FTSE 350 businesses, let's say, could be significant because we're talking about huge companies like Aviva, Barclays Bank, Tesco, AstraZeneca and the Lloyds Banking Group. The good news, though, is that technology is being developed quickly that should mitigate against some of these risks that particularly crop up in audit claims, especially around first-party fraud. Now, just to flag there, a common misconception that is the auditor's job to detect fraud. It isn't. Those with primary responsibility for the prevention and detection of fraud are those charged with the governance and management responsibility for the business. However, it is the auditor's job to take reasonable steps to satisfy themselves that the financial statements of the company, taken as a whole, are free from material misstatement. Now, this includes having to look at the controls and processes that the business has in place and identify where they're not suitable or fit for purpose. And this is where we see lots of audit claims arise, especially where fraudulent employees manipulate financial records and the auditor doesn't pick that up. But tech is beginning to show signs of putting auditors into a much stronger position. It's still at an early stage, but there are a couple of examples. So open banking, for instance, allows auditors to obtain bank statements directly from the bank to ensure they're working with complete and accurate records that haven't been manipulated. It can also be used to complete routine audit tasks like confirmation of end-of-year balances, checking, validating particular transactions, and even revenue testing. And the ICAW has also identified blockchain technology as a possible way to provide auditors with immediate access to invoices, credit notes, statements, and receipts, so they can see the whole of the transaction that they might test to validate what happened. The good news is that development of tech should ultimately make an auditor's job easier. However, on the other hand, it will give claimants more sticks to beat an auditor with when mistakes are made, because the tech available will raise standards and set the bar higher. It's also likely to evolve the way that fraud is carried out. So there's good and bad. The main risk in the short term is that the big four are investing heavily in tech, which may not immediately drip down to the smaller firms that are stepping up to take on the joint managed process. I can also see claims arise between auditors where there are gaps between which auditor is doing which part of the audit, and risks slip through the cracks. So potentially a hotbed for contribution claims and just claims arising by the business and the claimant bringing it. In conclusion, the good news is that we haven't seen a spike in claims. There are positive signs that tech is likely to provide a solution to many of the risks that we often associate with audit claims. And whilst HMRC are raising lots of inquiries, they're often challenged with a high degree of success where there are grounds to do so. It's potentially too early to say what impacts the hybrid working or permanent home working arrangements will have, but tech is also developing quickly to meet some of those risks, especially cyber risks. Ultimately, I think the economy is likely to be the biggest factor as to whether we see a flood of claims against accountants. With inflation and the cost of living rising, interest rates creeping up to manage all of that, and signs the economy could now open without any further restrictions, we are in a moment where what happens next to the economy is likely to really shape the claims environment for accountants and other professional advisors. Now, to pick up and continue with trends, I'll hand over to David Gooding.
Thanks very much, Liam. I just wanted to make a few observations on some regulatory themes, so just move the conversation on facing accountants, but also how they might impact on claims. This is quite a big topic, so I'm just going to tackle it over the next sort of 5 to 10 minutes with just providing with some headlines and very much some initial thoughts today. I think first and foremost, just looking at regulatory changes, and Liam's highlighted some of these, they are coming down the track, and in particular for some of the large audit firms. Now, I think this is partly in reflection of some quite high profile cases against some of the large firms over the last few years. You might be familiar with, there's an investigation into KPMG over its involvement with Carillion that's actually culminated in KPMG self-reporting over misleading the regulator. So that's just one example. There's plenty of others as well, which we think are impacting on the decision to change the regulatory landscape and improve it. So what's happening exactly? Well, the Financial Reporting Council, the FRC, which sets the rules and enforces them in respect of corporate governance and audit. So the regulator for the large audit firms, that's evolving into a new regulatory body. And we think over the next 12 months, that's going to be called ARGA, Audit Reporting and Governance Body. And the clue's in the name where the focus of that body is going to be. So that's at one end of the scale. So we think there's going to be a stream of new standards and possibly a different type of enforcement as well. But that is all coming down the track. At the other end of the scale, so probably talking about much smaller firms or boutique tax practices, there's also talk of enhanced regulatory standards and compulsory professional indemnity for tax advisors. So we're looking at here tax advisors who are not members of professional bodies such as ICAW or the ACCA. So they're effectively unregulated. So there's talk of new rules coming into place, and those advisors having to have mandatory PI cover. Now, I flag all this simply because regulatory governance is very much de rigueur. We are talking about more regulation, we think, not less. So what does this mean in practice for firms and their PI insurers? Well, I think one might think that enhanced regulation and higher standards would hopefully lead to fewer claims in the long run, and hopefully better risk profile for firms. And I think, on the whole, accountants are seen largely as a relatively safe risk. So hopefully one would think that enhanced standards would improve that over the long run. This also takes me on to the second point I wanted to raise around regulation, but rather looking at complaints. Now, I've noticed, and I think we have generally in our national team, an uptick in the amount of regulatory complaints being made to firms, professional bodies such as ICAW or ACCA. Not per se, I don't think there's been an increase statistically, certainly the numbers being produced by ACCA, but rather an uptick in the number of complaints coming in at the same time as a civil claim. Now, this seems interesting to me because I think there is a theme of deliberate ploys by claimants and their lawyers to turn up the pressure on firms and their insurers, knowing that firms are obviously very concerned about regulatory oversight of their businesses. So they think essentially a letter of complaint to ICAW is going to turn up the pressure. And it does in many respects. And the difference today is that this seems to be a far more common pattern. Now, in the years gone by, one would have expected to see the majority of those complaints raising issues of probity or integrity in relation to firms and their members. Whereas today, a lot of these letters going in relate to service issues. So essentially, we're looking at a complaint that mirrors the negligence claim. And as you probably know, ICAW and ACCA, they will investigate service complaints. I was reading only yesterday a case of a sole practitioner who was struck off for gross negligence in the way in which he'd managed his own firm's systems for their own client and office accounts. It wasn't a question of integrity in that case. So what does all this mean in practice? Why am I talking about this? Well, as a defence lawyer, you've got an extra layer of complexity to the claim. On one hand, you've got to protect the insurer and the insured's position on the defence of the negligence claim. But if you know a complaint's gone in to ACCA or ICAW, you need to be very mindful of the impact of that on the firm, but also how that firm should respond to the regulator. There needs to be an element of consistency. So, for example, the approach on the negligence claim might rightly be to send in a pretty aggressive and strong response to it. However, if that response is passed over to the regulator, who will want to know what is happening with the civil claim, that might put his or her back up if they're investigating whether or not to send this to a prosecutor. That might not be the right response for that complaint. Equally, a problem can be that if a claimant is armed with an investigator's decision to send this up to a tribunal, that will fuel the civil claim. So, one must always have in mind what the left hand and the right hand are doing, where we've got these parallel claims. I haven't got all the answers today, but I think that really the purpose of this is just to remind adjusters and policyholders that it can be really sensible to manage both of these complaints and claims together. Now, in terms of the cost of that, on the policy side, certainly under the minimum terms, there is no automatic cover for regulatory complaints, but sometimes there are bolt-ons on policies that we see, and in particular where they're not ICAW minimum terms policies. And the bolt-on will provide additional costs for panel to assist the insured behind the scenes with the regulatory investigation. Sometimes the insured may make a contribution, sometimes they'll instruct us separately. There are also some practical things you can do. So, for example, we would make it very clear to a claimant solicitors right at the outset that either them threatening to bring a complaint or actually bringing that complaint isn't really appropriate, and the correct forum for making their claim is through the professional indemnity pre-action protocol. Equally, we will urge the insured to make it very clear to the regulator a number of things. First is that they'll provide all and any cooperation with the investigation, but at the same time flagging that it might be appropriate for the investigator just to hold off until the civil claim's been resolved. But equally that the firm doesn't have a free run at defending the complaint or the negligence claim because of insurers' involvement, and that certain correspondence between the insured and the regulator really should be kept confidential. At the same time, these investigators at ICAW and ACCA, they tend to be pretty experienced and quite well qualified. They'll often know why that complaint is being made. And sometimes they can be a bit more relaxed if they know that the insured is just trying to resolve that dispute behind the scenes, and they might agree just to hold off with their investigation. Just on a final note, it's crucial for firms to notify these regulatory complaints ASAP. And that might be an obvious point, but if they do, and they really should, because to all intents and purposes they're either claims or circs under the policy, but if they do, insurers can assist them a lot better if brought at an earlier stage, and it's certainly in their interest to get some professional support, and in particular before the investigator decides to launch a full-blown investigation, let alone hand her file over to a prosecution colleague. So there's just some comments around the regulatory themes. Just with a very short time available, I'm conscious of the time, I just wanted to very quickly, just one policy issue. And I spoke about a year ago on minimum terms for accountants and some of the key issues. So I'm not going to repeat any of that here. It's still on our website if you wanted to have another look at that. But one key change that is coming through at the moment is in relation to silent cyber. So an accountant's minimum terms policy with ICAEW that will now have a reference to an exclusion for silent cyber. Now, to all intents and purposes, the policy will remain the same. There will not be an exclusion for third-party claims, so claims by clients against a firm arising out of a cyber breach. But what that exclusion will reiterate is that there is no first-party cover. So there's no cover for the insured in relation to losses it suffers as a result of a cyber breach. Whether these exclusions are going to become more extensive, that's a discussion for another day, as some of this is quite controversial. But that's all we've got time for today. I hope it's been informative for you. For those of you who've got some questions, we won't wait for the Sue Gray report. We'll allow another 15 minutes, and I'm going to hand over to Harriet in a moment. But if you don't have time or you'd like to, please just email us if you've got any points or questions or queries. You've got our details, and also look out for our bulletins on the subjects that we've discussed today. Thanks very much for listening, and I'm going to hand over to Harriet Strevens now.
Thank you very much, David. We have had several questions, and I'm going to confine us to one each given the time allowed. And if I might start with Lisa. Lisa, the question that's been asked is, was the decision in Knights a fair one, or do you feel it was too lenient in favour of the defendant? I think you're on mute,
yes,
Lisa.
I am. Yeah, thank you, Harriet. My own view is that it was a fair one. The defendant had made it clear to Knights that they were making introductions only, and expressly said that in their letter of engagement and the 4 limitation of liability letters. I think the court's going to look at the relationship as a whole, and in this case, it found all of those things to find in favour of the accountant. So I think it was fair. I think what came out of that is how important it is to properly document the relationship between the parties and all of those practical things that I mentioned earlier on. And I think if you have all of those, then it's going to give some comfort to firms and their insurers in that situation. So yes, I do think it was fair.
Thank you very much indeed. Liam, you paint a somewhat gloomy outcome for smaller accountants taking on the minor role in the managed share audit. It sounds as though without investment in IT, the smaller firms will struggle. Is that true? When it comes to it, and when it comes to IT, the quality of the output is only as good as the input. And if that's right, shouldn't the SMEs retain their share of the marketplace?
Good question. So I don't want to paint a gloomy outlook. I just think it's a little bit about learning initially. So the input and output bit at the end of the question, I think that probably relates more to the records that the business is keeping, because the tech that I'm talking about is tech that auditors will use to carry out the audit function. So to test the records of the business so they can be satisfied that the financial statements are accurate. I think where this is heading, I think a lot of the smaller firms will look to recruit experienced audit partners who've worked at some of the bigger firms and have carried out audit work for a long time. So I think they'll get the experience in that way. And then it's about training up their teams. When it comes to the tech that is being developed, the Big Four will inevitably lead on that because they're making heavy investments, but I expect it to drip down. There will be third parties that develop tech to attack this space that fully expect smaller firms to buy and get on license. I think where this is probably going, though, is that technology is changing the way that we all do our jobs. And for accountants in particular, I think that some of the volume work, especially end of tax year filings and things like that, I think tech could develop to sort of meet that. And if that happens, then I would expect a lot more firms to take on more advisory work because it's more profitable. But then that would introduce lots of changes, and that's something else for insurers and accountants to think about in terms of risk.
Right. David, just a question for you, please, if I may. Do you think the compulsory insurance cover for the non-members tax advisors would be a good thing? And do you think it's right to assume that the thinking behind that is coming from an increase in claims against them?
Thank you, Harriet. This is actually probably more controversial than I first thought, and I know this because I posted some comments on this on LinkedIn about 3 months ago and received a whole barrel of different sort of commentary. This depends on who you are, I think, because there are different people affected by the proposed mandatory PI. So for a policyholder, that's going to add a whole layer of cost and extra training. They're going to have to find an insurer that's going to cover them. So there is some concern in the industry. So from their perspective, it's not necessarily a good thing. From insurers, well, there's going to have to be interest in the market for these policyholders. And at this stage, it's not quite clear what the level of premiums are going to be, nor what the mandatory terms are going to be. If they're going to mirror the ICAW minimum terms, those are some of the most gold-plated professional indemnity terms you can find anywhere. So these might be quite expensive. You might end up putting firms out of business. But on the other hand, I think, and this is sort of in answer to your second point of your question, I think this is largely aimed at Joe Public, where they can have some certainty and some comfort that if they're going to instruct somebody to provide them with tax advice, that individual entity will have professional indemnity cover. Now, there's been, and I'm aware of, a sort of a whole host of organisations, not just simply sole practitioners, who have gone bust, not renewed their PI, or there hasn't been a run-off cover for their PI. I've never even had PI, and individuals, and often firms of accountants who've referred the claims to the specialists have been left high and dry. So I think this is largely where the changes are aimed at. So from that perspective, where there is additional cover in the market, where firms who have referred people to tax specialists and are being brought in now have actually a third party that they can pursue, I think that will be a good thing. But we've just got to wait and see until there's more, I think, meat on the bones, Harriet.
Thank you very much indeed. We've actually got a couple more minutes, so I'm going to stretch it somewhat and go back to Lisa, if I may. Lisa, another posted question is, I'm reading from Adam Bradford's question. He says, out of interest, with the tax scheme claim, did the defendant accept any commission or fee from the scheme promoter provider? It goes on to acknowledge and appreciate that the letter of engagement and terms were clear, but do any of you, and you, Lisa, see accountants being found guilty because of remuneration being accepted for introducing clients to a scheme, regardless of the strength of the letter of engagement?
Thank you, Harriet and Adam. In terms of the judgment, that wasn't a point considered in the judgment, so I assume not. But I could see a situation where if they were accepting remuneration for referrals, that would not be something positive in support of an argument that you weren't assuming a responsibility, because arguably you are then recommending something for other reasons. So it is I think a good point for consideration. I think again it feeds into looking at all the aspects of the relationship between the parties, and one thing which I think would go down on the side of not supporting the firm's position.
Yeah, I think that must be right, wasn't it? Liam, were you why were you surprised to hear that so many SME owners were likely to fall foul of the new digital bookkeeping rules? What is it that they haven't done or should have done?
I think I was more surprised at, it's a small pool interviewed, but 40% of them, I think, was the proportion, still don't operate with electronic records and still have paper-based system and taking photographs. So I think it was more about that. When it comes to deadlines, so this was in the context they're making tax digital the VAT deadline, so that comes to force April this year. So lots of the deadlines over the course of the next couple of years for the other aspects that have been digitalised. It's a deadline, so I expect things to change between now and then, but it was more about how the accounting information is being maintained. One of the articles suggested that hard copy documents were kept in desk drawers and shoe boxes, so it was more that.
One should never laugh. Come the revolution and all the electronics collapse, the people with the quills and the pens will be sitting comfortably. However, we move on to our last question from Martin Bartholomew. Either David or Liam, or even Lisa, not even, but Lisa, perhaps you'd like to address this question. Would a PI insurer potentially pay a cyber attack, a ransom demand, if the firm couldn't pay or didn't have cyber cover? Not doing so would presumably lead to a negligence claim. Do you have views on that, David?
Do you want me to pick this one up? If this is a ransomware attack on the firm and the firm makes a claim under its professional indemnity policy, say it's an ICAW firm, I don't think that will be covered unless the ransomware attack led to some sort of breach of duty towards the firm's clients. So say the ransomware attack led to the disclosure of confidential information or data, or the loss of money, and the client suffered a loss. If the client suffers a loss as a result of a breach of duty on the part of the firm of accountants, that is the type of liability that would typically fall to be covered. But you may have a situation there where there's a dual cover if they've got a bespoke cyber policy. But I think the question was if they didn't have one. But if this is just simply losses suffered by the firm as opposed to third-party losses, then it's just not going to be covered in the absence of a cyber policy.
In fact, the question actually also asks if the firm couldn't pay, not just that it didn't have cyber cover.
Yeah, I hope that answers your question, Martin. But if you want us to pick that up separately, do let me know further.
Thank you all very much indeed. We've now run out of time, so I'll pass you back to David to close down this session. Thank you.
I just want to say thank you very much for listening, everybody. And as I said before, I hope that's been informative. Please do look out for the next session of A Brief Account. It's probably going to be an interview with an industry specialist, as we've been running it over the last sort of 12 months. And any other questions, please do email us and get in touch. Thank you very much indeed. Bye-bye.